learnt about the rules for revenue recognition. We said we need to recognize revenue when it's number one, earned, and number two, realized or realizable. Realized means the cash is received. Realizable means we are reasonably sure, reasonably certain that we're going to collect the cash. So let's look at the rules once again. So you have the rules for revenue recognition. So we're looking at revenues here, and the rule is it should be earned and realized. That means cash is received or realizable. That is when we recognize revenue. Revenue could be from the sale of goods. So let's say I'm selling pens, sale of goods. It could be from rendering of services. It could be interest income, dividend income, royalties income. So for every revenue, every income, the rule is it should be earned and realized or realizable. For expenses, we have learned we're going to match expenses to revenues. So if you're looking at, let's say, COGS, cost of goods sold, these are product costs. So we're going to match cost of goods sold to goods sold during the period. We're going to match it to the products sold during the period. SG&A, selling, general and administrative expenses. We've learned that these are period costs. So we're going to match these costs to the period in question. Let's say it's income statement for the year. So we're going to match the period cost, the SG&A, to this period, to the year. So non-operating expenses, let's say interest expense, again, we're going to match it to the period. So guys, we know that the revenue recognition rules and the expense matching rules, these are the foundations for accrual accounting, foundations for US GAAP. We're looking at highlight expense recognition. So expenses are generally recognized when economic benefits are consumed or when assets lose future benefits, and they generally follow the matching principle. So expenses may be matched to the associated revenues, and that's for product costs like COGS. Expenses may be recognized when cash is spent or liability incurred, especially for period costs like SG&A. Or expenses may be allocated by systematic and rational procedures to periods benefited. For example, period costs like depreciation or insurance. Now we look at accruals and deferrals. First, let's talk about accruals. For accruals, it could be accrued revenue or it could be accrued expenses. Whenever we say accrued, we mean yet to receive or pay. I mean, let's say we have earned the revenue, but we haven't yet received it. We haven't yet touched the cash. If it's an accrued expense, we have incurred the expense, but we have not yet paid out the cash. So it's basically yet to receive in case of a revenue or pay in case of an expense. Let us say we have accrued revenue. We have earned the revenue, but we have not yet received the cash. So let's look at our revenue recognition rules. So we have accruals. We're saying we've earned it and it's realizable. It's not yet realized, we have not yet touched the cash, but it's still realizable. So earned plus realizable. Do we recognize the revenue? Yes, of course. So when it's earned and realizable or realized, that is when we recognize revenue. So we're going to recognize this accrued revenue. So the journal entry for accruals is going to be receivable debit to revenue. Guys, think of it. If the cash was received immediately, it would be cash debit to revenue. But because the cash is not yet received, it's realizable, it's a receivable. Now, think about it. Receivable, this is a balance sheet account. So, the receivable would go on the asset side of the balance sheet. Revenue, that's an income statement account. So, this would go on our income statement. It could be sales revenue. It could be revenue from rendering of services. It could be non-operating revenues. But one part, the debit, goes to the balance sheet. It's an asset, receivable. The credit, that's an income. That's revenue on the income statement. How about an expense? So let's say we've incurred an expense, not yet given out the cash. So in that case, it's an expense debit and it's a payable credit. Now once again, the expense that goes on to our income statement, that's an expense. Could be COGS, could be SG&A, could be non-operating expense. So this goes to income statement. How about payable? Payable is a liability on the balance sheet. So guys, this is a very good way of understanding journal entries. Whenever you're looking at accounting, so remember I said financial accounting and reporting. Whenever you're looking at accounting, whenever you're looking at journal entries, always think of reporting. Where does it go on your financials? This really helps. Now, when you're looking at accruals, so I said revenue is receivable to revenue, recognition of revenue. Expense is expense to payable. Now, let's think of it. When I'm selling pens, what's my journal entry? Accounts receivable, if I'm selling pens on credit, to sales revenue. So accounts receivable goes in here, sales revenue. Let's say I'm doing royalties for books and I'm yet to receive my money for royalties. Receivable, royalty is receivable to royalty revenue. Royalty receivable goes in here, revenue on my income statement. Again, expense to payable. Let's say I have used the building for this year. I haven't yet paid out the rent for this building. What's an expense? Rent expense. What's payable? Rent payable. Rent expense goes in here. Rent payable goes into the balance sheet. Now, think about it. We've said yet to receive or pay. At a later date, we're going to receive the cash or pay the cash. So here we're going to receive the cash. Here we're going to pay the cash. Let's look at the journal entries there. So later. So now we have this journal entry, receivable to revenue. At a later date, the receivable is going to give us the cash back because we are yet to collect it. So we're going to get cash. So we're going to debit cash because cash is going to increase to receivable. So if you think of it, receivable was debited when we passed the accrual journal entry, but when we received the cash later, the receivable was credited. It's a wash. So if you look at both these journal entries together, it's basically cash to revenues. Just that revenue was not realized, it was realizable. The realizable revenue which was recognized right now got realized later. So later we received the cash. Same thing for an expense. So it's an expense to payable. I've used the building for this year, I haven't yet paid the rent. Now think of it, it's a payable now. Later, I'll have to pay the cash to clear off my liability. So I'm going to debit payable and my cash, that's going to go out. Now, if I look at it, payable was a credit here, a debit here. This is a wash. So it's basically expense to cash. Just that I haven't paid out at this point. I paid it later. So at this point, it's an accrued expense. At this point, this is an accrued revenue. Okay, this makes it very easy to understand. Let's get to the book, look at accruals, and then we'll come back and talk about deferrals. We're looking at accruals. So right here, yet to receive or pay. So when we're looking at accrued revenue, that's yet to receive or yet to realize the cash. So the journal entry for that is highlight debit is receivable accrued asset and the credit is highlight revenue. For the debit receivable, write B/S because that goes to the balance sheet. The credit revenue, write I/S because that goes to our income statement. Now when it's accrued expense, that's yet to pay. So we've incurred the expense but have not yet paid out the cash. So the debit is highlight expense, the credit is highlight payable or accrued liability. Beside the debit expense, write I/S because that goes to the income statement. Beside the credit payable, write B/S because the payable is on the balance sheet. Now we got an example of accrual for revenues on this page here. You can review this when you get back home, but guys, understand the basic conceptual journal entries. Remember, for accruals, you are yet to receive the cash or yet to pay the cash. We've looked at accruals where we have earned the revenue or incurred the expense but haven't received the cash or paid out the cash. Now when we talk about deferrals, that's when we've received the cash or we've paid the cash but we haven't yet earned the revenue or incurred the expense. So deferrals is basically received in advance or paid in advance. Let's talk about deferred revenue first. So it's a case where we haven't yet earned it but we've collected the cash. So let's go and look at our revenue recognition rules in a moment. So we have looked at accruals. Let's look at deferrals. We are saying we have realized the cash, we've received the cash, received it in advance, but we haven't yet earned the revenue. Is it recognized? For recognition, both the rules need to be complied with, earned and realized or realizable. In this case, it's realized but not yet earned. Revenue is not recognized at this point. So let's look at a journal entry on the board here. So we have cash received in advance. So we have cash debit because cash is coming in, and the credit is to deferred revenue. Now it could also be called revenue received in advance, or you could also call it unearned income, unearned revenue. Revenue which we haven't yet earned. We've realized it, not yet earned. So guys, now if you look at this, the debit, the cash is a balance sheet account. Our cash increases. Deferred revenue, that's a liability because we have collected cash, not yet given the service or not yet sold the goods. So this again goes to the balance sheet. Look for accruals. For accruals, the debit went to balance sheet in case of accrued revenue, but the credit, that was income statement. Here, both the accounts go to the balance sheet. Let's look at deferred expense. Now, in this case, we've paid out the cash, but we haven't yet incurred the expense. Let's say here I said, I've used this building for this year, but I haven't yet paid out the rent. Let's say I got another office where I have paid the rent for the next year right now. So in that case, cash has gone out. I've already paid out the cash. So cash is credit. The debit is not to an expense account. The debit is to an asset account because right now it's a deferred expense or a prepaid expense. Also called prepaid expense. Once again, deferred expense, that's a balance sheet account. As I told you, that's an asset on my balance sheet. Cash, that's again a balance sheet account. In this case, deferred revenue, that was a liability on my balance sheet. So guys, as you understand, both the debits and the credits are balance sheet accounts. Nothing is going to the income statement. As I told you, we've seen deferred revenue, don't recognize revenue yet. Why? Because you haven't earned it. Don't expense. Why? Because you haven't incurred it. Only at a later date, when you earn this revenue, when let's say you supply the goods or you render the services, that's when. So on a later date, when you actually earn it, in that, then you would debit deferred revenue and credit revenue, because that is the point when you would recognize revenue on your income statement. So you're going to reverse this liability and recognize revenue. For expense, let's say you have paid out the cash right now, haven't yet incurred it. Now next year when you actually use the office space, that's when you would incur it. So what you would do is you would expense, so you would debit the expense and you would reverse off this asset, you would credit deferred expense or prepaid expense. So ideally, if you look at it, the deferred revenue, this and this would become a wash. If you're looking at deferred expense, this and this would become a wash. So the net journal entry for now and later would be cash to revenue, expense to cash. So guys, this is basically, if things are not happening in cash, if it's not happening right away, so it's like earned and cash, earned and realized, it's then you would have accruals. Or it's realized but not yet earned, then it would be a deferred. So accrual is cash is yet to come, you're yet to see the money or you're yet to give the money. In deferral, the cash comes right away, cash is coming first. So if you realize cash is right here, cash is right here. In case of a revenue, you receive the cash. In case of an expense, you give out the cash. Cash comes first. In this case, cash comes later. Cash comes later. So that's the difference between accrual and deferral. Very important. Let's look at it in the book and we'll come back and do a problem. We are looking at deferrals, which is right, received in advance or paid in advance. So for deferred revenue, the cash is received, but revenue, it's not yet earned. So the journal entry here is highlight cash debit and deferred revenue credit. Now cash, that's a balance sheet account. So write B/S. Even for deferred revenue, that goes into a balance sheet, right? B/S. Now when we're looking at deferred expenses, the cash is paid in advance, but the revenue is not yet incurred. So the journal entry here is deferred expense debit, highlight that, and credit is to cash because cash is going out. Deferred expense, that goes into your balance sheet, right? B/S. Cash, that's also a balance sheet account, B/S. So guys, one thing for you to realize in case of deferrals is there is no income statement impact yet, because for revenue, deferred revenue is revenue received in advance, not yet earned, so not recognized on the income statement. For deferred expense, it's paid in advance, but expense is not yet incurred and hence not recognized on the income statement. So we know for accrual accounting, we recognize revenues when they are earned and realized or realizable. Now in cash basis of accounting, which is non-GAAP, not allowed as per GAAP, what we are bothered about is realization. We're not looking at whether revenue is earned or realizable. Only when it's realized, it's a revenue. So we'll talk about cash basis as an other comprehensive basis of accounting in the next section. But for now, what happens is on a lot of CPA exam question, they give you the amount of revenue received, that's realized, or expense paid during the period, and they give you beginning and closing accruals and deferral balances. So let's look at one problem like that, rather a couple of problems like that, and let's understand how to solve those problems. Very easy, and I'll give you a lot of tricks. I'll give you how to do it from an accounting point of view, and I'll also try to explain to you the reason why we are debiting or crediting. So we have an example in the book which says innovation company received royalties on its patents in two ways. In some cases, advance royalties are received, and in other cases, royalties are remitted within 90 days after year end. So advance royalties are received, that's deferred revenue. In other cases, royalties are remitted within 90 days after year end. So that's an accrual yet to receive. So some cases it's deferral, some cases it's accruals for royalty income. Now it says the following data are included in innovation company's December 31st balance sheets. So you have royalties receivables, that's opening and closing balance for that, and unearned royalties. Royalties receivable, that's from accruals, receivable. Unearned royalties, that's deferred revenue, unearned revenue. So you have the beginning and closing balances. Then you have during 2010, innovation company received royalty remittances of $200,000. That means cash that they received was $200,000. In its income statement for the year ended 31st December 2010, calculate innovation company's royalty income. So they have given us the cash basis income. If this was a cash basis company, if they accounted for using the cash basis, royalty income would have been 200,000 amount of cash that they realized. But that's not GAAP. As per GAAP, it's you have to account for accruals and for deferrals. So let's look at that. The way we're going to do it is we're going to create T accounts, a T account for accrual and a T account for deferral. So let's do that. So you have two T accounts here. One is for accrual. So one is for accrued revenue or revenue receivable. So this is royalty accrued. Let me call it revenue accrued or receivable. The next T account, that's for deferral. So that's basically royalties deferred, or let me call it revenue deferred. Basically this is received in advance. Now revenue accrued or receivable, that's what? That's an asset, that's a debit account. So look at it, receivable to revenue, that's a debit account, that's an asset. So the accrued revenue, the beginning balance of $80,000. So balance as of 1/1/2010, that's $80,000. That's a debit. The closing balance, what they've given us is $75,000. So balance as of 1/1/11, the next year, that's $75,000. Now let's look at revenue deferred. Revenue deferred, that's credit, that's a liability. So that would be a credit opening. So when you have the opening balance as of 1/1/10, they have given us $50,000, and the opening balance for next year, rather the closing for this year, that's $25,000. What else they have? They have given us royalty or revenue for the period, or royalty income. Now they have given us the amount of cash that we have received during the year. So amount of cash received during the year is $200,000. So cash received during 2010, cash is $200,000. Now if this was a cash basis accounting, then this would have been the figure for royalty income. But this is not cash basis, because cash basis, that's not GAAP. So we have to adjust for accruals and deferrals. Now let's look at accruals. In the beginning of the year, they had $80,000 which was receivable. During the year, they might have provided a lot of services, also received some cash. So whenever they provided services, it would have increased the amount of receivable. When they received the cash, it would have decreased the amount of receivables. And the net effect of all these multiple transactions is basically the asset or the receivable got reduced from $80,000 to $75,000. What it means is they received more cash, this part was a little more than the service that they have rendered. Guys, there would have been a lot of transactions, a lot of all these services rendered, because that would increase the amount of receivable. This is cash received. So what we are saying is the amount of cash received looks to be more than service rendered, which is approximately 5,000 bucks. So if you have $5,000 here, 80 minus 5, that's 75. So the amount of cash received exceeds service rendered during the year by $5,000 for all royalties that are received after the service is rendered. Now think about it. We are starting from this basis, $200,000. Now here some excess cash has been received. Cash has been received more than the service rendered. So this number of $200,000 should be reduced by $5,000. Why? Because excess cash is received. This $200,000 is cash. Now this is excess cash received, more cash than service rendered. So this should be reduced by $5,000. Or in other words, the credit here should become a debit here. So this credit here comes down, becomes a debit. This is, I would say, cash is in excess. So let me use the same pen. So I would say cash received is more than service rendered. Now let's look at the deferral. Now in this case, the beginning deferral was $50,000. So beginning received in advance was $50,000. During the year, they would have received more advances. There would have been more amounts of cash received. And they would have rendered services. When they rendered services, this deferral would reduce. Now, what it looks like is 50 minus 25 would give us 25, right? So 50 minus $25,000. What it looks like is they have rendered more services than the cash that they have received. More services have been rendered than cash received during the year. Think about it. 50 minus 25 gives us 25. So more services. So services that have been rendered is more than the cash that has been received. So we are starting with a cash number. So we have to increase this number because services has been rendered in excess of cash received. Or in other words, the debit that's here needs to become a credit here. So debit here needs to become a credit here. That's for $25,000. This is, we could say, the cash received, or rather the service rendered is greater than this, is greater than cash received. So in that case, if we plug it all, so we're going to do $200,000 plus 25 minus 5. So 200 plus 25, 225 minus 5, that becomes 220. That's the amount which goes to the income statement. So income statement amount would be 200, that's the cash, plus 25 minus 5, 220 goes to the income statement. So guys, as per cash basis, 200 is the answer, but cash basis, this is non-GAAP. So this is not allowed. Accrual basis, the right answer is 220. So guys, it's not too difficult. What you need to understand is you need to draw two T accounts, one for accrual, one for deferral. Simply plug the figures. So I could say $80,000 minus $5,000 give me 75. 50 minus 25 gives me 25. Then you have a revenue or an expense account. So in this case, it's royalty revenue. Revenue is a credit. Now whatever is debit here becomes a credit here. So this debit becomes a credit. So this debit here becomes a credit here. This credit here becomes a debit. So 200, again if you credit income becomes 225 minus 5, what goes to the income statement is 220,000. 200 plus 25 minus 5, 220. Let's look at this problem on the book and we'll come back and look at the same thing for expense accounts. We have the same example that we just solved on the board. So we looked at royalty accrued, that's royalty receivable, yet to receive, as well as royalties deferred, that's royalties received in advance. And we used the numbers from both royalty accrued and royalty deferred to calculate the accrual basis royalty income. So we had the cash basis number, the royalty received in cash during the year, $200,000. So right there, cash basis. Then we used plugs from deferral and accrual to calculate the amount which goes into the income statement, $220,000. And this is GAAP basis, or right, accrual basis.
Well, we've got another similar example.
So when you look at the royalty income T account, the cash number of $200,000, right, cash basis there. For the amount which goes into the income statement, right, accrual basis. For revenue recognition, we looked at earned and realized or realizable. For expense, we know we need to match it. We need to match it to the product or the period. So we're looking at expense incurred, whether or not paid out by cash. So if the expense is incurred, cash not yet paid out, that's an accrued expense. Expense to payable, liability. When it's cash paid out, but the expense not yet incurred, that becomes a prepaid or deferred expense, cash paid out. Now, we have seen a problem here where we had the cash number for revenues and beginning and closing accrued and deferred revenue. How about a similar problem for expense, where we have the beginning and closing for expense accrued and the beginning and closing for expense deferred and the expense paid out in cash during the period. So let's look at the example in the book which says the following data are included in Regus Company's 31st December balance sheets. So you have rent payable and prepaid rent, beginning and closing balances. During 2010, Regus Company paid rent for $35,000 in cash, and its income statement for the year ended 31st December 2010 calculate their rent expense. So again, let's do the 3T accounts. We've done this for revenue. Let's now do it for expense. So we're going to have accrued expense and deferred expense. So expense accrued, that's payable. Revenue accrued, receivable, that was something which is to come in, asset. Expense accrued, that's a payable, that's to give out, that's a liability. So you have the beginning balance of $6,000 and the ending balance of $9,000. Then you have rent deferred, or rather I would call it expense deferred, or in other words, paid in advance. Revenue received in advance, that was a liability because we've received it in advance. Paid in advance, that's an asset because we have paid out, not yet incurred it. So they've given the balance is 8,000 becomes 5,000 by the end of the year. 5,500 at the end of the year. Let's look at the expense account. So you have the rent expense, the cash paid out. So in case of revenue, the cash paid out was a credit because revenue is a credit account. Expense, that's a debit account. So you have 2010 cash is $35,000. Now, similar logic that we had for revenues, we're going to use that for expense now. So expense accrued, all this is all the expense incurred during the year, and the expense payable is reduced by the cash that is actually paid out. So this is cash paid. Now what we realize here is the expense incurred is more than cash paid because 6,000 you need to add 3,000 to make it 9,000. So 6,000 we need to add 3,000 here. We need to add $3,000 to make it 9,000. 6,000 plus 3 gives us 9. So the expense incurred is more than cash paid. If expense incurred is more than cash paid, naturally this expense number, the cash number, needs to be increased. So, or if this is getting a little too difficult, complicated for you, simple, it's a credit plug here, a credit plug here needs to become a debit down here. So this $3,000 needs to become a debit, plus $3,000 here. Now, when you're looking at expense deferred, so you have all the expense incurred should be credit here. So the expense incurred would reduce the deferral because you've paid out advance. As you start using the services from your vendor, the advance gets reduced, and this is all the cash that you pay out during the year. That increases the deferral, increases the paid in advance. Now in this case, the plug is 8,000 plus or minus 8,000 minus. So 8,000 minus 2,500 would give us 5,500. What it means is the expense incurred, this part, has been more than cash paid. So then you have to add to the rent expense, or in other words, it's a credit amount here, needs to be debit here. So you would add 2,500 here. So on the cash basis of accounting, which is not allowed as per GAAP, rent expense was $35,000. The amount as per GAAP would be 35 plus 3 plus 2.5 would gives us 40,500. The amount which goes to the income statement, that's 40,500. That's the expense number on the income statement. So this is cash basis, this is accrual accounting GAAP basis number. So guys, simple thing that you need to remember is you need to create 2T accounts for accrual and for deferral. So accrual and deferral for revenue here, accrual and deferral for expense here. You need to create the revenue and the expense account. Make sure you do credit to debit, credit to debit. You are doing credit to debit here, debit to credit. So make sure you're posting on the opposite sides, getting the right number. Understand the concepts here. As I told you, what we are looking at is, in this case, expense incurred was in excess of cash paid, so it increases the expense. Expense incurred more than cash paid increases the expense. So we looked at rent accrued or payable, basically yet to pay, as well as rent deferred, that's paid in advance. And then we had rent expense paid out in cash during the year. So $35,000 of rent expense paid out in cash, that was cash basis. Now on that cash basis number, you use the plug from accrual as well as the plug from deferral, and that helps you calculate the amount which goes into your income statement, basically the accrual basis number. So right there, accrual basis. Now, few smaller companies often use the cash basis of accounting because it's very simple. Think about it. All revenue realized or received in cash is revenue for the period. So it's 200,000 here. There's no adjustment. All expenses paid out in cash, that's expense for the period. Now, accrual basis, as we know, can be pretty complicated. You need adjustments for accruals, for deferrals. Layman might not understand. You need certified public accountant CPAs like us to do the accrual basis of accounting. Now, naturally, some smaller companies cannot afford us expensive CPAs for the entire year. So what they do is, during the year, they follow cash basis of accounting. And at year end, they call us up. They ring us, they call us CPAs to come in and clean the mess, to convert the cash basis of accounting books to accrual basis. So let's look at an example in the book here, and it's pretty interesting. So it says, dollar company uses cash basis during the year and adjusts to accrual basis every 31st December. Calls in a CPA, moves from cash to accrual. It's 31st December 2009, corrected accounts receivable balance is $15,000. So the opening balance for accounts receivable is $15,000. Let's use the same template that we have here. So it says accounts receivable balance. The opening balance is rub this entire thing here. So you have use the same template. So it says the beginning balance for accounts receivable is $15,000. To rub out this ending, need to rub out the cash. Yeah, that makes it clean. So accounts receivable, accrued revenue, receivable. So that was 15,000 in the beginning of the year. During 2010, whenever the cash is collected, the company debits cash and credits sales. Therefore, the 31st December balance in accounts receivable before adjustment is still $15,000. They didn't do anything, it's still $15,000, remains as it is, because during the year they didn't touch this account. So whenever they made a sale, or rather sorry, whenever they received cash on a sale, they recognized it as revenue, cash basis, right? So whenever they received in cash, realized the cash, that was revenue. They didn't touch accounts receivable. So therefore 31st December 2010 balances in accounts receivable before adjustment is still $15,000. Past necessary journal entries if number 1, the correct balance is in accounts receivable is 22,000. Let's take a dummy figure for here. Let's assume that the amount of cash that they collected during 2010 was $100,000. So the revenue that they have here is $100,000. But this number is untouched. Now at the end of the year, when the CPA comes in, he sees that this number, which is 15,000, should have been increased to 22,000. Should have been. But this number was untouched because guys, think about it. Let's do what should have been done and what they did. So what should have been done, or rather what should have been done under the accrual basis, and what they did in the cash basis. So if you look at it here, $15,000, another 7,000 must be added to make it 22. So there must be a 7,000 added in here to make this one $22,000, which is the correct balance as of year end. 7,000 debit here would mean a credit of 7,000 here, which means that the sales for the year, which is recorded at $100,000, the cash received should have been 100 plus 7, 107. So what should have been recorded under the accrual basis would be accounts receivables to sales 107 and cash received to accounts receivable 100. Right? So the sales should have been made of 107 and cash to accounts receivable. This would have been the accrual basis of accounting. But they didn't do this. During the year, they messed it up. They followed cash basis. So what they recorded was, they recorded cash to sales 100,000. So only the cash that they had realized was recorded as revenue, cash basis. So now think about it. So you have cash of 100, this and this matches. What has actually happened is accounts receivable was debited 107, credited 100. So there is another debit which is to come for 7,000. Sales should have been 107, but sales has been only recorded 100. Should have been credited 107, should have been. Has actually, they've done only 100. So sales credit 7. So if we as CPAs, we go in, it's a mess for the entire year. We just pass this one simple journal entry. We debit accounts receivable 7,000, credit sales 7,000, everything is cleared. The cash basis of books becomes accrual basis for reporting purposes. So guys, I'm sure you're understanding it's same as what we've done. What they have is, they have this cash number or the cash that they've received during the year, and they have the beginning and closing balance for accounts receivable. So we're going to look at the accounts receivable and sales ledger accounts, and we're going to just pass a simple journal entry, make it crystal clear, clean up the mess. Look at the second one here. So you have, what if the correct balance in accounts receivable was $10,000? So if instead of $22,000, this was $10,000. In that case, it should have been 15 minus 5 to give us 10. This 5 credit here should have actually been a debit here, 5,000. So it should have been 100 minus 5. Sales which is recorded at 100 should have been 95. So in that case, what would have happened is, let's change the numbers here. The cash received remains the same. It remains 100. Yeah, the cash received remains 100. The sales should have been 95, but they have recorded 100. So in that case, the reversal journal entry would be, think about it, cash received 100, they've debited cash 100. Accounts receivable was debit 95, credit 100. Should have been, basically there should have been a net credit of 5, there is no credit here. So instead of, we'll create a journal entry where we'll credit accounts receivable 5, debit sales. Sales should have been 95, has been done 100. So we have to reduce sales. Sales has been overstated, reduce it by 5. So if the right balance in accounts receivable instead of 15 was $10,000, so 15 minus 5 would give us 10. So in that case, we would bring this credit, make it debit here. Sales would have been 100 minus 5 or a 95. So the right journal entry would have been accounts receivable to sales of 95 and cash received 100. Naturally, they would not have recorded anything which is on accrual basis. They've done cash basis for the entire year. They would only have recorded cash to sales of 100. So now what we would do is we would reduce sales by 5 because they have recorded sales of 100 instead of sales of 95. So we'll reduce sales by 5 and we will also reduce accounts receivable from 15 to 10 by 5. So guys, it's just an adjustment that we do at year end. We come in, we pass a single journal entry that cleans up all the mess, converts cash to accrual basis. When making journal entries to adjust from the cash basis to accrual basis, it is important to identify two types of amounts. First one, highlight current balance and underline cash basis. Next, highlight correct balance and underline accrual basis. Next bullet says, it is also important to highlight, understand the relation between balance sheet accounts and income statement accounts. So it says, when adjusting the balance sheet accounts from cash basis to accrual basis, the other half of the entry will generally be related to a related income statement account. So highlight accounts receivable adjust to sale, accounts payable adjust to purchases, prepaid rent that would adjust to rent expenses. So we just did an example on the board. So you got solution part 1 of 2 where the current balance in accounts receivable was $15,000 and the correct balance was $22,000. So how about making a T account here? So make a T account, write A/R, the current balance, write $15,000, put a plug for $7,000 and the correct balance, write $22,000. For solution part 2, you have the current balance is $15,000 but the correct balance is $10,000. So draw the T account again, write 15,000 current balance, put a credit plug for $5,000 and the correct balance, that is $10,000.
We're looking at error corrections where adjusting journal entries may be used to correct misstatements. To understand our example better, let's write journal entry for recording sales. So if it's credit sales, you're going to have AR or accounts receivable debit and sales credit. Now, if credit sales are overstated by $75,000, then you need to actually pass a reverse journal entry. That's the adjusting journal entry where you debit sales and credit accounts receivable. So when you debit sales by $75,000, draw an arrow which goes downwards. You reduce sales by $75,000. Similarly, as you credit accounts receivable, you are again reducing it by $75,000. Draw an arrow which goes downward. To understand the next example, let's write journal entry for recording COGS, cost of goods sold. So you debit COGS and credit inventory. So COGS is an expense item on your income statement. Inventory, that's an asset which sits on your balance sheet. As you sell goods, your inventory reduces on the balance sheet and it becomes an expense which is COGS on your income statement. So the second example says inventory of $40,000 was omitted. That means inventory is understated. So you got to increase inventory by $40,000. That's why you debit it. So draw an arrow which shows increase going up. And the adjustment, the other side of that journal entry would be COGS, where you credit COGS by $40,000. As you credit COGS, it sort of reduces the cost of goods sold on the income statement. So these are a couple of examples that you could use to correct errors, and we call these adjusting journal entries.